Investing is a valuable skill for students to learn as it can set them up for financial success in the future. For students, there are various investment options to consider, such as stock market. Students can begin investing in the stock market through individual stocks, exchange-traded funds, ETFs, or mutual funds. It's important for students to research and understand the basics of how the stock market works before making any investments. Robo-advisors. Robo-advisors are automated investment platforms that can help students with managing their portfolios based on their risk tolerance and investment goals. These platforms often have low fees, making them accessible for students with limited funds. Retirement accounts. Students can consider opening individual retirement accounts, IRAs, if they have earned income. Traditional and Roth IRAs offer tax advantages and can be a great way for students to start saving for retirement early. Education funds. Investing in 529 college savings plans or education savings accounts, ESAs, can help students save for their own education expenses or for the education of future children. Peer-to-peer lending. Some students may be interested in peer-to-peer lending platforms where they can lend money to individuals or small businesses in exchange for returns. When investing, students should prioritize building a diversified portfolio, understanding the risks associated with different investment vehicles, and avoiding high-risk investments that could jeopardize their financial stability. It's essential for students to educate themselves about financial markets and seek advice from financial professionals or mentors before making any investment decisions. Investing in the stock market can be a great way to potentially grow your wealth over time. However, it's important to approach it with caution and a clear understanding of the risks involved. Here are a few tips to consider before investing in the stock market. Research and educate yourself. Before investing, take the time to learn about how the stock market works, different investment strategies, and the companies you're interested in investing in. There are plenty of resources available online, such as books, articles, and online courses that can help you build a strong foundation of knowledge. Set financial goals. Determine your financial goals and risk tolerance before investing. Are you looking for long-term growth, or are you more interested in generating income from your investments? Understanding your goals will help you make more informed investment decisions. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying your investment portfolio by spreading your money across different asset classes and industries can help reduce risk and protect your investments from market volatility. Start small. If you're new to investing, consider starting small and gradually increasing your investment as you gain more experience and confidence in your abilities. Monitor your investments. Keep an eye on your investments and stay informed about the companies you've invested in. Stay abreast of market trends and news that may impact your investments. Consider professional advice. If you're unsure about where to start or how to manage your investments, consider seeking advice from a financial advisor or a professional with experience in the stock market. Overall, investing in the stock market can be a rewarding way to build wealth, but it's important to do your due diligence and approach it with a long-term perspective. Make sure to carefully consider your risk tolerance and investment goals before putting your money into the stock market. Robo-advisors are digital platforms that provide automated, algorithm-driven financial planning services with minimal human intervention. They can be a convenient and cost-effective way to invest for individuals who may not have the time or expertise to manage their own investment portfolios. When considering investing in robo-advisors, here are a few key factors to consider. Fees. Robo-advisors typically charge a management fee based on a percentage of the assets under management. It's important to compare the fee structures of different robo-advisors to ensure you're getting the best value for your money. Investment approach. Different robo-advisors may have different investment philosophies and approaches. Some may focus on passive index investing, while others may offer more active management strategies. Consider whether the robo-advisor's investment approach aligns with your own investment goals and risk tolerance. Diversification. Look for a robo-advisor that offers a diversified portfolio of assets to minimize risk. Make sure the robo-advisor takes into account your individual financial situation and risk preferences when creating your investment portfolio. Customer service. Although robo-advisors are automated platforms, it's still important to consider the level of customer service and support they provide. Look for a robo-advisor that offers responsive customer support and clear communication. Track record. Consider the track record and reputation of the robo-advisor before investing. Look for reviews and ratings from independent sources to gauge the robo-advisor's performance and reliability. Overall, investing in robo-advisors can be a convenient and affordable way to build and manage your investment portfolio. However, it's important to do your research and carefully consider your options before choosing a robo-advisor to ensure it aligns with your financial goals and preferences. Investments in retirement accounts are a fundamental aspect of retirement planning. These accounts are designed to help individuals save and invest money for their retirement years, providing tax advantages and a dedicated vehicle to plan for the future. There are different types of retirement accounts, including 401k plans, individual retirement accounts, IRAs, Roth IRAs, and others. Each type of account has its own specific rules and contributions limits, but they all share the common goal of helping individuals save for retirement. When it comes to investing in retirement accounts, individuals have the opportunity to allocate their contributions into a variety of investment options, such as stocks, bonds, mutual funds, and other assets. The specific investment options available will depend on the retirement account provider and the individual's risk tolerance, time horizon, and financial goals. It's important for individuals to carefully consider their investment options within their retirement accounts, as these accounts play a critical role in ensuring financial security during retirement. Diversification, risk management, and long-term growth should all be taken into account when making investment decisions within retirement accounts. Ultimately, investments in retirement accounts represent a key strategy for building a strong financial foundation for retirement. By contributing regularly and making informed investment decisions, individuals can work towards achieving their retirement goals and enjoying a financially secure future. Investing in education funds can be a smart financial decision for individuals who want to save for future educational expenses. Education funds, such as 529 plans and education savings accounts, ESAs, offer tax-advantaged ways to save for college and K-12 expenses. Here are a few reasons why investing in education funds can be a good idea. Tax benefits. Education funds offer tax advantages such as tax-deferred growth and tax-free withdrawals for qualified education expenses. This can help investors maximize their savings and reduce their tax liability. Flexibility. Education funds provide flexibility in terms of how the funds can be used. They can be used for various education-related expenses, including tuition, fees, books, and even room and board for college. Long-term planning. By investing in education funds, individuals can start saving for future educational expenses early, allowing their investments to grow over time. This can help alleviate the financial burden of education costs down the road. State-specific benefits. Some education funds, such as 529 plans, offer additional state-specific benefits, such as state income tax deductions or credits for contributions. This can provide an extra incentive for investors to save for education. Generational wealth. Education funds can be a way to transfer wealth across generations. They can be used to fund the education expenses of children, grandchildren, or other family members, helping to build a legacy of educational opportunity. It's important to carefully consider the different education fund options available and consult with a financial advisor to determine which option best suits your financial goals and needs. Additionally, it's important to be aware of any potential fees, expenses, and investment risks associated with education funds before investing. Peer-to-peer lending, P2P lending, is an alternative form of investing that involves lending money to individuals or businesses through online platforms, bypassing traditional financial institutions like banks. Here are some considerations to keep in mind if you are thinking about investing in P2P lending. Diversification. As with any type of investment, diversification is important in P2P lending. Spread your investments across multiple borrowers to reduce the impact of any potential defaults. Risk and return. P2P lending can offer higher potential returns compared to traditional savings accounts or bonds, but it also comes with higher risks. Borrowers may default on their loans, leading to potential loss of principal for the lender. Due diligence. Before investing in P2P lending, it's important to conduct thorough due diligence on the platforms and borrowers you are considering. Understand the platform's underwriting process, borrower screening criteria, and risk assessment procedures. Platform selection. There are various P2P lending platforms available, each with its own set of features and criteria. Research and compare different platforms to find the one that best suits your investment goals and risk tolerance. Legal and regulatory factors. P2P lending is subject to regulatory oversight in many jurisdictions. Make sure you understand the legal and regulatory framework governing P2P lending in your area and ensure that the platform you choose is compliant with relevant regulations. Liquidity. P2P lending investments are not as liquid as stocks or bonds. Most platforms offer secondary markets where investors can sell their loan investments, but there may be limitations and restrictions on selling your investment. Tax implications. P2P lending income is generally taxable, so be sure to understand the tax implications of your P2P lending investments and consult a tax professional if necessary. Monitoring and management. Once you've invested in P2P lending, it's important to monitor your investments and manage your portfolio actively. Stay informed about the performance of your loans and be prepared to take action in case of any issues. Overall, investing in P2P lending can be a potentially rewarding way to earn passive income, but it's important to approach it with caution and thorough research. As with any investment, consider your risk tolerance, investment goals, and financial situation before diving into P2P lending. When investing, students should prioritize building a diversified portfolio, understanding the risks associated with different investment vehicles, and avoiding high-risk investments that could jeopardize their financial stability. It's essential for students to educate themselves about financial markets and seek advice from financial professionals or mentors before making any investment decisions.